Hello everyone, welcome to the Tim Booker channel. Wishing you all a delightful listening experience. Today, I'll be discussing a book titled, How to Make Money in Stocks. Written by William O'Neill. O'Neill is one of the most successful veteran investors on Wall Street. He was born in 1933 and began trading stocks at the age of 21. By the age of 23, he officially entered the stock brokerage profession. At the age of 30, he founded a stock brokerage firm named after himself. O'Neill lived through events such as the Watergate scandal and the stock market crash triggered by the oil embargo. He also witnessed the frenzy of technology stocks in the late 20th century. Despite the ups and downs of the bull market, he continued to thrive in the stock market. He is not only a trading master with over 50 years of practical experience, but also an entrepreneur. In 1984, he founded Investors Business Daily, which grew rapidly and eventually became a major competitor to The Wall Street Journal. In addition to publishing newspapers, O'Neill is also a best-selling author. The book we are looking at now, How to Make Money in Stocks, is the fourth edition. The first edition of this book was published in 1988. With over 2 million copies sold in the United States. Over the past 30 years, countless ordinary readers, guided by O'Neill, have achieved substantial profits and even life-changing experiences. Among them are newlyweds, who started trading stocks with $7,000 in wedding gifts and $5,000 in savings. In just a few years, their net worth reached 7 figures. There is also a retired restaurant owner who invested $400,000 and made $700,000 in profit. Even more astonishing is a real estate agent who, during the stock market crash of 2008, managed to profit by an incredible 130%. What has benefited these readers the most is O'Neill's famous CAN-SLIM method. CAN-SLIM. This is the essence of his investment approach, and the core content of this book. O'Neill is a trading master who values research. He selected the top 100 performing stocks from the million stocks in the American market. Through the study of these top-performing stocks and their performance before significant price increases, he formulated 7 rules. The combination of the first letters of these 7 rules spells out CAN-SLIM. After comparing O'Neill's CAN-SLIM method with the approaches of Peter Lynch and Warren Buffett, the American Association of Individual Investors published an independent research report in 2001, stating that using the CAN-SLIM method, investors can achieve the best and most consistently stable performance each year. In 1991, O'Neill's 24-year-old partner, Gil Fishtrom, participated in the U.S. Investing Championship. By applying the CAN-SLIM method, he became the runner-up with a 279% return that year. This championship was not a simulation but a real money trading competition in the market. In 1992, he once again secured the runner-up position with a 120% return. Whether the market is in a bull or bear phase, investors who strictly adhere to the CAN-SLIM method can achieve success in real-world trading. Now, let's go through the 7 rules represented by the 7 letters one by one. First, let's talk about the letter C. It stands for the current quarter's earnings and the current quarter's sales of U.S. stocks. When you're choosing stocks, you must look for stocks with significant growth in current quarter earnings. The higher the earnings, the better. O'Neill conducted research on the best-performing 600 stocks from 1952 to 2001 and found that before these stocks experienced significant price increases, over 70% of them had outstanding performance in the latest earnings reports. Their earnings increased by an average of 70% compared to the previous reports. For example, Cisco Systems, in the 2 quarters before October 1990, saw earnings increase by about 150%, and its stock price subsequently rose steadily, increasing 15-fold in 3 years. Dell Computer, in November 1996, announced earnings for the previous 2 quarters, with its U.S. stock earnings increasing by 70% and 100%, respectively. In the following 27 months, Dell's stock price increased 18-fold. Of course, such stocks are not numerous. In the U.S. stock market, only 2% of stocks meet these standards. However, O'Neill believes that what you should look for are these star stocks with outstanding performance, not the ordinary ones. Furthermore, to avoid the impact of seasonal factors on the performance of some companies, you can use the year-over-year growth indicator. This means comparing this quarter's U.S. stock earnings with the U.S. stock earnings from the same quarter of the previous year. This way, you can make an objective evaluation of the company's operations. However, it's essential to note that one-time, non-recurring earnings should be excluded from the financial reports. For example, if a computer company's earnings for the previous quarter included a significant profit from selling a property, it doesn't truly represent the company's ongoing profitability, and such earnings should be removed from the reports because they are typically one-time occurrences. Whether you're a stock market novice or an experienced investor, it's a good idea to set a threshold for the stocks you want to invest in. O'Neill recommends that if a stock's earnings in the most recent quarter did not increase by at least 18% compared to the same quarter of the previous year, you should absolutely avoid that stock. Many successful investors even set the bar higher, requiring a minimum increase of 25% or 30% in earnings in the most recent quarter as the criterion for stock selection. For added security, stocks with significant earnings growth in the past 2 quarters should be the focus of your attention. Additionally, you should also consider the sales figures in the quarterly or annual reports of stocks. It's best to select stocks where sales and U.S. stock earnings are increasing in tandem. Stocks with such synchronized growth in sales and earnings have greater potential for future increases because to maintain steady growth in U.S. stock earnings, sales must keep pace, otherwise, the growth in U.S. stock earnings becomes unsustainable. Furthermore, if a company's growth rate has consistently been around 50%, but the latest quarterly report suddenly shows only a 5% increase in earnings, its prospects may not be promising. Of course, even the best-performing companies occasionally encounter poor performance. It's advisable to check whether their earnings have significantly declined for 2 consecutive quarters. If so, it's best to steer clear of such companies. Alright, after discussing C, let's move on to the second letter, A. It represents the annual earnings growth rate. The minimum requirement for this indicator is that the annual earnings growth of a stock should be at least 25% for you to consider it. For exceptionally outstanding companies, this growth rate can even be as high as 100%. Following the principle of selecting the best among the best, you would certainly choose such stocks. Ideally, the stocks worth investing in should have maintained a stable growth pace for the past 3 years. If it's a newly listed stock without a 3-year earnings record, you should ensure that over the past 5 to 6 quarters, there has been significant earnings growth, and the revenue should be impressive. This stock selection criteria essentially eliminates approximately 80% of the listed companies in any industry. So, let's take a look at who remains. For instance, Stryker Corporation had a 32% annual earnings growth rate in 1962. Subsequently, from March 1963 to June 1966, its stock price increased 7-fold. Between 1977 and 1990, Walmart's stock price soared 112 times, while its annual earnings growth rate had consistently been at 43% before that. Speaking of earnings per share, we must mention the price-to-earnings (P/E) ratio, which is the ratio of a stock's market price per share to its earnings per share. Over the years, many analysts have considered the P/E ratio as an important measure when selecting stocks. If the P/E ratio is low, it indicates that the stock is undervalued and should be bought. Conversely, if the P/E ratio is high, it suggests selling. However, O'Neill's research on the top 100 performing stocks between 1880 and 2008 revealed something contrary to most investors' beliefs. He found that in fact, there is no correlation between the P/E ratio and stock price movements. So, don't let a high P/E ratio deter you from considering a potential superstar stock. Generally, the average P/E ratio per share is around 15 times, while the most exceptional stocks can have P/E ratios ranging from 25 to 50 times. For example, the tech giant Google, in 2004, consistently had a P/E ratio fluctuating between 50 to 60 times, and its stock price subsequently saw more than a 3-fold increase over the next few years. Now, let's move on to the third letter, N. It represents new products, new management, and new stock highs. O'Neill conducted statistical analysis of the best-performing stocks in the market from 1880 to 2008 and found that for stocks with astonishing earnings growth, over 50% of them met at least one of these 3 criteria. For example, due to the discovery of a new oil field, Houston Oil and Gas Company's stock rose nearly tenfold from 1972 to 1973. Then, in 1976, it increased threefold. As Microsoft's products dominated the personal computer market, from March 1993 to the end of 1999, its stock price surged almost 18-fold. Publicly traded companies often achieve significant boosts in performance by developing remarkable new products, leading to substantial increases in stock prices. However, when it comes to stocks reaching new highs, O'Neill conducted a survey during his investment lectures, revealing that 59% of individual investors indicated they would not buy stocks at new highs. This tendency is not limited to individual investors, most institutional investors also exhibit such investment habits. If you can't change this mindset in a timely manner, you may miss out on potential superstar stocks. Many stocks that appear to have already reached high prices can go even higher. So, when it comes to stocks reaching new highs, how should you determine the specific timing to buy? We will discuss this in the practical techniques below. The fourth letter of the Ken Slim method is S, representing supply and demand for stocks. This rule is quite straightforward: scarcity is valuable. If you have two stocks to choose from, one with a float of 5 billion shares and the other with a float of 50 million shares, when other conditions are relatively equal, the stock with the lower float often performs better. This is why many people favor small-cap stocks. Additionally, pay attention to companies that engage in stock buybacks on the open market. Repurchasing shares reduces the available supply in the market, which can subsequently boost U.S. stock earnings. For example, International Game Technology, IGT, announced repurchasing 20% of its stock in 1989 and 1990. By September 1993, its stock price had increased over 20-fold. The fifth letter in the Ken Slim method is L, which stands for leaders. In general, the top 3 companies in a strong industry become potential leaders, while other companies in the same industry may have mediocre performances. For instance, the retail industry leader, JCPenney, saw its stock price increase tenfold from 1988 to 1992, while other companies in the same industry performed poorly. It's essential to note that industry leaders are not necessarily the most well-established companies in the sector. Pay attention to emerging companies with explosive performance. Additionally, in the late stages of a bear market, when the market experiences a rebound, the stocks that rebound to new highs are the leaders you should be looking for. The sixth letter in the Ken Slim method is I, which represents institutional sponsorship. It indicates how many shares of a stock are held by institutional investors. A successful stock doesn't need to have a large number of institutional investors watching it, but it should have at least a few. Additionally, knowing whether the total number of institutional investors holding a stock is increasing or decreasing is equally important. If a stock has shown stable earnings and trading volume over the last few quarters and the number of institutional investors is increasing, it can be a good choice. However, be cautious of the risk of a stock being overowned by institutions. The term overowned was introduced by O'Neill in 1969 to describe the phenomenon of a stock being held by too many institutional investors. When a bear market occurs, overownership can turn into a potential mass sell-off, leading to a so-called stampede event. In the summer of 2000, Cisco Systems stock was held by over 1,000 institutional investors. When its stock price took a dive, institutional investors began heavy selling, causing a significant drop in stock price that seemed unstoppable. The last letter of the Ken Slim rule, M, represents judging market direction. O'Neill hopes that individual investors will never ask others, "How's the market doing now?" Most Wall Street analysts couldn't even predict the stock market's peak in the year 2000. You should learn to assess market cycles on your own and must follow the market trend when investing, without deviating from it. Investors in the stock market may lean towards fundamental analysis or technical analysis. O'Neill, however, is a seasoned investor who values both fundamentals and technicals. Therefore, his timing and stock selection strategies also consider both aspects. He advises individual investors to learn to precisely analyze the daily changes in stock indices, trading volumes, and the price movements of leading stocks to gauge the overall market trend. Now that all 7 stock selection criteria represented by Ken Slim have been explained one by one, it's crucial to effectively integrate them in practical application. Most successful stocks exhibit all 7 characteristics during their upward phases. If you find a stock that meets all 7 criteria, congratulations, as it has a significant potential to become your money-making machine in the stock market. O'Neill has navigated and thrived in the U.S. stock market for 50 years and has encountered many investors who either lost money or saw little progress in their accounts. He believes that individual investors looking to excel in the investment market must first analyze their own weaknesses. Whether an investor is a newcomer or an experienced veteran doesn't matter. In fact, some experienced investors with bad investment habits can face even more severe consequences. What are considered bad investment habits? In this book, O'Neill identifies 21 of them. Let's focus on analyzing the 5 most common bad habits. 1. Holding on in small losses, refusing to exit until losses become substantial. This is a mistake nearly all investors make at some point. Holding on to a losing investment with the hope that it will rebound is often fueled by wishful thinking. However, more often than not, waiting leads to larger losses. O'Neill emphasizes setting a stop-loss standard. Sell if the stock price falls 7% or 8% below your purchase price. Don't hold on to losing positions. 2. Buying stocks during a price decline, only to get trapped deeper. Purchasing stocks while their prices are dropping may seem like a bargain, but it often results in getting caught in a downward spiral. O'Neill shares the example of a woman who bought shares of Xerox at $34 when it hit a new low. A year later, the stock was trading at $6. 3. Not learning how to use candlestick charts and missing trading opportunities. Individual investors should invest time in learning how to read trend charts and recognizing reliable breakout patterns. Trading based solely on gut feelings without analyzing candlestick charts can cause investors to miss out on significant opportunities. 4. Preferring to buy low-priced stocks. Many investors are tempted by stocks priced at $2, $5, or $10. However, cheap doesn't always mean good in the stock market. O'Neill advises buying the best stocks, not the cheapest ones. The best stocks aren't necessarily the most expensive, but they are rarely cheap. Most institutional investors avoid stocks priced at $5 or $10, let alone those under $5. 5. Relying on rumors and inside information when buying stocks. O'Neill believes that many of the rumors and inside information circulating in the market are often baseless. They might originate from someone's casual remark without factual basis. Even some so-called expert opinions on television can be unreliable. O'Neill stresses the importance of conducting thorough research and understanding the true situation of the stocks you plan to buy as the first step to making money in the stock market. Alright, we've covered the Cancellium stock selection rules and some common bad habits of investors. Now, let's dive into the practical aspects, focusing on 2 parts, capturing buying and selling points and some stock selection tips. First, let's discuss how to identify buying points. In 1957 to 1959, the Czech leader De Levers fund outperformed competitors by twice the returns. At that time, O'Neill was relatively new to the field and was in the learning phase from the experts. In 1960, after studying the fund's trading records, O'Neill discovered that the 100 stocks he bought in the past year were all purchased after they hit new highs. When a stock had been fluctuating in the range of $40 to $50 for several months, De Levers would quickly buy it at $50 to $51 after it broke its previous high. This revelation inspired O'Neill, and he formulated his buying rules. 1. Buy when a stock breaks out of a reasonable consolidation phase and is about to or has just hit a new high. 2. Simultaneously, the stock's daily trading volume should be at least 50% higher than usual. Buying when a stock hits a new high is crucial and often an excellent buying point, especially after it has traded sideways for some time and then suddenly breaks out upwards. Once you're in, the only thing to do during the holding period is to look for good selling points. Legendary figures on Wall Street believe in one principle: take profits while they're good. It's like riding an elevator, get off when it's going up, don't wait until it starts going down again. O'Neill provides 5 signals for market tops, indicating good times to sell stocks. 1. The stock has its largest single-day price increase, and the closing price is significantly higher than any previous day during the uptrend. 2. The largest single-day trading volume occurs, indicating the highest volume day during the uptrend. 3. A breakaway gap appears on the trend chart. To identify a breakaway gap, O'Neill gives an example. If a stock that has been on a long-term uptrend closes at $50 one day and opens at $52 the next morning, maintaining an upward trend throughout the day, it creates a $2 gap, which is considered a breakaway gap. For the last minute, frantic buying occurs. This is when you see a stock experience rapid, consecutive weekly gains or 8 to 10 consecutive days of strong gains on the daily chart. 5. The signal of main players, institutional investors, exiting the market. After a long uptrend, if trading volume reaches a massive level but the stock price doesn't move significantly, showing stagnation, it's a sign that smart investors are selling. These are the times to consider selling your stocks. In this book, O'Neill also provides 2 practical stock selection tips, the follow-through day and the relative stock theory. Let's first discuss the follow-through day. Typically, when one industry makes significant progress, related industries tend to benefit. For instance, in the late 1960s, the aviation industry saw a resurgence due to the introduction of jet planes, leading to a rapid increase in stock prices. A few years later, as the aviation industry prospered, the hotel industry also started to thrive as it expanded its branches to cater to the growing number of travelers. This led to a strong upward trend in hotel industry stocks. Similarly, in the late 1970s, when oil prices began to rise, not only did oil company stocks surge in 1979, but stocks of oil service companies providing equipment and related services also soared. In the mid-1990s, with the boom of the internet industry, the demand for high-speed internet access and broadband became insatiable. Companies specializing in the fiber optic industry benefited greatly from this internet frenzy. So, when selecting stocks, you can consider this pattern of one hot industry leading to the potential rise of another related industry. Now, let's move on to the relative stock theory. When one industry performs exceptionally well, there is often a supplier or a related company that reaps the benefits, which O'Neill calls a relative company. For example, when Boeing sells many jet planes, it also needs chemical lavatories produced by a company like Monogram. As profits surged, Monogram's stock price increased tenfold. In 1983, Fleetwood Corporation was a super-performing stock in the recreational vehicle field. It had a relative company, Dexter Corporation, whose stock price also performed impressively. Dexter specialized in providing interior cabinets and hollow core doors for recreational vehicles and mobile homes. So, when you notice an outstanding company, thoroughly research it, and you might uncover such relative relationships, allowing you to identify promising investment opportunities. Of course, everything has 2 sides. When one industry is thriving, everyone benefits. However, if that industry encounters problems, the related industries or companies that benefited earlier are often the first to be affected. For instance, in the early 1980s, when the oil industry faced challenges, it eventually impacted the entire oil service industry, leading to a significant downturn. Alright, we've now covered the main content of this book. It has been published for 30 years and has helped thousands of ordinary investors identify outstanding stocks. In the 4th edition, many real success stories are recorded. O'Neill encourages investors not to be discouraged by bear markets and setbacks. There will be many bull market opportunities in the future. He quotes a saying from former U.S. Secretary of State General Powell, "Success is not a secret, it's the result of preparation, hard work, and learning from failure." Congratulations on completing another book, and thank you for your support and attention. Please subscribe to the Tim Booker channel, like, and share this valuable knowledge with your friends. Let's combine wisdom and practice to achieve our financial goals and create a better future. Thank you, and goodbye.